ascertain in price action. So I sit on my hands. I'm not interested. In trading this long, but I'm also not trying to pick the top either. I want to see how the market can produce a turn lower. I don't need to pick the top in that. And I want to see the market provide a time-based delivery. That's a macro. And I'll talk about macros in this lecture series and how I'm going to employ them with this model. It is not, again, it's not the panacea. It's not the be-all end-all with macros. It's just how I arrived at a model using them. You can make lots of different models. I could make a model every single day using the macros, 365 days, and they would never be the same model. Okay, it provides you such a wonderful tapestry of applying this information on an individual and unique basis. Nobody's trading model is going to be the same. And it doesn't mean that you can't be profitable. All of you can be profitable with a different model using what I've already taught in Smart Money Concepts. So since we have the opening range gap here defined and we have all the gradient levels here, obviously moving half gap, which would be much more significant of a move, I don't require that. What's the highest probability direction that it's likely to trade to? Go below this low, because that's the lowest low of the day, at the new start of regular trading hours. That means 9:30 today. And then the next quadrant is here. So 21,672 even, to me, is high probability. It means it's likely to draw to this low and as much as that level here. And it could trade down to half, but I'm not going to require that. So what's low hanging fruit objective? Eventually trading down here. What's high probability draw? The upper quadrant, using the opening range gap. And I'll talk more about it in its own individual video, but for here, it's accomplished the method. So now what we're going to do is we're going to go up to a 60-minute chart. And I want you to look at how we have the data that's shown here. This is the opening range gap on the 60-minute chart. Again, regular trading hours. If you look at over here, we have this drop from high down to that low. This is a lot of gaps in here. So I'm going to remove all that mess and noise and go into electronic trading hours. And we're going to clean up that range. So now I can go and look at this same thing here. So we have this high and this low. So this was the old range, okay, or old dealing range. If I note this, like this, and this low here, when the market broke below this low here, the market was bearish. Now, obviously, I know there's going to be some, very cynical people that I'm never going to see the comment from. They're going to say, "Oh, it's obvious, it's hindsight." But you have to do this stuff in back testing, studying it, get the information, see it, get used to seeing the pattern, get used to seeing the order flow, and then how the market runs for liquidity. But we can see how it was bearish here, and the market creates a low, lower low, lower low, and finally does, in fact, trade below that low here. So what was resting below that low? It's sell side. So because we are not demanding that the market created a low or long-term or intermediate-term low here to trade back above this high, we don't need to have that high broken. So all I need to know is, where is premium? Where's discount relative to now this high and this low? Why am I referring to those two reference points now? Because this range was attacked and traded outside of by these two lows here. And it's reasonable to see the price want to come back up, take out this high. What does this high form? Low, high, lower low that takes liquidity. That's a high probability ICT smart money concept breaker. It's a bullish breaker. And you can see that's occurring right there. Trades higher. And all of these buy side liquidity pools here, here, here. And then this one here has the added benefit of what to the left of it. An inefficiency in the form of a sell side imbalance, buy side inefficiency. So we can take this little area here and zoom in. Right there. So it's this candle, and this candle. So if we highlight that, this price, And we'll make it like that. So that way it flips a little bit. So we have this closing price to this opening price. This closing price is slightly higher than that one. That's why I'm using it, because this is a small little tiny volume imbalance. If you look at the closing price, which I don't show here, let me add them now. I apologize. The closing price here is $21,695.75, and the opening price here is $21,694.75. So there's a difference of one handle, but that's enough to create a volume imbalance. So that's why we're using this opening price and not the wick. Okay, so otherwise, if this closing price was overlapping where this price opened or candlestick opened, there wouldn't be a volume imbalance. So because there's a volume imbalance, we have to use this candlestick's opening. Otherwise, if this was lower than this candlestick's opening, it would be resting on this candle's wick high. Same thing here. This candlestick's closing price comes in at $21,894 even. You see that here. And this candlestick's open is what? $21,893.75. So it's 1/4 of a point, okay, or one tick. So there's a separation there. So we have to anchor the sell sign imbalance, buy sign inefficiencies labeling or overlay with the rectangle tool on this candlestick closing price. If this candlestick's closing price was lower than this candlestick's open, we would simply use this candlestick's low on the wick. So that way, now you understand how I'm going to use that information when I'm looking at SIBs and buy sign imbalance, sell sign inefficiencies, BISIs. All of my inefficiencies are defined like that, okay? By doing this, you're going to get the algorithmic precision of where consequent encroachment is. And you'll see what I mean in a moment. So I'm going to take this and highlight the extend to right. And that way, when we draw back out to this perspective, everything will be clear. So now we have several things in reference now. We have this inefficiency here that is inside of a premium. How do I know that? Well, we have this range low and this range high. So the market has traded between this range high down to this low. This level here defines equilibrium. And anything at that price or higher is a premium. That means it's expensive. It's a target for when you're bullish, or it's a place at which you want to use to sell short at. At this price or lower, it's discount. That means it's a target for anything that's short, or it's a place to go long when you want to be bullish. Well, since the market has worked off a bullish breaker here, it trades up. I'm not interested in going long here. Why? Because we have a large opening range gap at 9:30 opening. So I don't want to be in this market doing anything long, because I want to see how it's going to trade to this inefficiency here. So we have the upper quadrant, which is right around what optimal trade entry would be. Remember the old flagship idea that I taught on this YouTube channel? So the market trades up, hits that, and then it starts to roll over. And then what I want to see is, does the market in fact attack after 9:30's opening? Does it attack that upper quadrant, this level here, which is part of the opening range gap? So now with this frame of reference, we know that the market did in fact trade up into a premium. We completely overlap this sell side imbalance, buy side inefficiency. So efficient delivery's been given. This one single candle down, what's it lacking? Overlapping price delivery that's on the upside. In other words, buy side is offered to the marketplace. That means a candle or candles, plural, has overlapped this entire range that's highlighted in pink. We see that happening here. See that? And then we have a small little wick outside of it, and then we break lower. And then it does, in fact, trade to the upper quadrant. It does not trade to the consequent encroachment or middle of the opening range gap, which again is defined by these two black lines here. So now we're going to drop into a 1-minute chart and flesh this out. If you look at what we've seen today, Initially at 9:30, we see the market, well, at 9:16, it dives down and does in fact trade to the upper quadrant of the opening range gap level, but we don't know what that level is, the upper quadrant, yet, because we have to have first the opening bell at 9:30. So that means at this candlestick right here at 9:30, you can see that that opening price is what it's laying on top of. So that's your opening price at 9:30 right there. Okay, so this upper quadrant level is not salient at this moment here. It just so happens that it does in fact trade down in there. Look at the bodies respecting that level as well. So I think that's a little algorithmic, but it's outside the scope of this discussion. At this point here at 9:30, then we do have the opening range gap defined by that opening price down to the previous day's settlement price. And then we have the lower quadrant, consequent encroachment, and the upper quadrant level, and then the opening price at 9:30. So this is in its entirety the opening range gap. So as I defined earlier, I'm only interested because we have such a large opening gap. It's several hundred handles. That means it could potentially keep trading higher in that direction. So you got to be real careful. It's too big of a gap. So I'm going to elect to not do anything by going long and chasing the direction of the gap. And I'm also not looking to sell short initially just to see it go down to the opening range gap and trade into the opening portion of it. I have to defer that interest until later on. What constitutes that? That means that we have to wait for it to trade up into that 60-minute imbalance. So it does in fact trade up into it. There, look at the bodies respecting it. This is a 1-minute chart. That small little deviation outside of that SIBI, and we spend some time here at the high end of it, and we start to roll over. And you can see how trading into the lunch hour, we're getting a little bit of a retracement. Notice the halfway point. This is consequent encroachment of this pink shaded 1 hour inefficiency. It's in a premium relative to the large 1 hour range. And now we're starting to work that level here. That's that midpoint of this pink shaded area. And they work through lunch like this. And then at 1:30, we start looking for the PM session trade. Now I have the market trading to the low end of that 1 hour SIBI. That's that pink shaded area here. So I've already seen it trade down below the midpoint, and then it traded back up to it. And look at the bodies respecting it. So is it indicating at that time that the market is wanting to explore anything higher? No. And at 1:30, we're now entering algorithmically the PM session or the afternoon trading. So what do we have at this point? We have the market trading up to and completing the full delivery to that 60-minute sell side imbalance, buy side inefficiency. Then we want to watch and see, does it move lower? It does. Does it breach the midpoint of that inefficiency? It does. Once it does that, does it show a willingness? These are all algorithmic signatures. These are indications that the algorithm that's offering price, it's not the buying and selling pressure, that the algorithm is offering the signatures proving, okay, like flashing a neon sign, like a billboard sign on a highway, that this thing is going to go lower. Don't anticipate anything in the upper range of this now, because it's already been fulfilled by this run here. And look how much time it's spent up there. So now at 1:30, the gears have now changed to now looking for the market to move lower. And now I have a trade stage where I can now engage price action. But I don't want to just simply go into it willy-nilly. That means I want to go in with something that's algorithmically timed by a macro. I want to target liquidity. I want to have a very simple entry strategy. And I want to know where it's likely to draw to, and then afford myself the opportunity to catch a runner if it wants to trade down to the midpoint of the gap or consequent encroachment, which is that blue line here. So I want to frame an idea around all those things. So let's take a look at that now. All right, so here we have the market trained in on the 250 to 310 macro time. We're trading near the low of that 60-minute SIBI. And here's that upper quadrant level on the opening range gap. And if I scrunch this up a little bit more, you'll see that the 50% level of the opening range gap is down here. So that is a wild card. I don't know, you don't know, no one knows if it's going to trade down there, but we do have a high degree of probability that it's likely to draw to that upper quadrant level. So that's what I'm focusing on in the trade idea. This candlestick, we opened lower here. The very next 1 minute candle, I want to be short. So when it opens, I want to use that open and anything that trades back into this candlestick's body or wick. So you can look at the low of that candlestick there. It's at 21,710.50. And by using that as a immediate rebalance, this next candle here, we open, we trade up a little bit. The high of that candle comes in at 12.50. And I only had basically 1.25 separation between the two. There was literally no drawdown at all from the entry though. It trades up to it, hits the immediate rebalance, and then delivers lower. So I have immediate feedback that I'm on one side. I'm targeting this level down here, but I don't want to just simply take profits as it hits that level. I want to try to get to that level and lower, because I might get lucky and see it trade to half the opening range gap. So I want to trade with this and watch how it delivers and move away from this 60-minute CIBI's low, which it does aggressively here. We have a little bit of retracement back and forth in here. And then finally, we have a little bit of, on this candlestick when it was breaking lower, I thought that we were going to have a pretty good chance of getting to that consequent encroachment of the opening range gap. So what I did was I rolled the stop to 21,666.50. And you can see that it does in fact hit that. And it was based on being in the upper portion of this body, so I felt if it did that, it probably would have rounded this low out and then move back up into this area and maybe trade back up into the 60-minute CIBI. And in fact, that's what you see here. So there's the the exit being stopped out. And here's the entry point there using the immediate rebalance. Okay. So those are concepts that were taught in 2024. Also, they were taught in core content. So it's all throughout this YouTube channel. And no, you don't find that in Wyckoff or GAN or anything else. So and I had to toss that down. You couldn't go without saying it, could you? No, I can't. I'm sorry. But that's just the truth, okay? So the difference is that there is about 50 handles or so between the entry point here and down there. Now, it's done with one contract. Notice that it's done with a micro. Now, when you first start trading, you might not look at this and think, wow, that's not a lot of money. But what this does is it gives you the confidence that you can, number one, see the price action deliver. You have some measure of precision. You don't need it to be perfect. You don't need to be surgical, but you have something that is lending well to the discovery of what you've seen on this YouTube channel and then put it into practice. And then you can make a model out of it. And then we get into the last trading hour of the day in regular trading hours, which is 3 o'clock. This thing could do what? It could start to draw back up into the range. And this is exactly what it did. So watching from that point on here, you can see that it does in fact trade higher and moves into consolidation and eventually trades up into higher portions of that CIBI, and then back down and outside of it once more, hitting that upper quadrant of the opening range gap level one more time. Look at the reaction off of that. You don't think that's algorithmic? Price comes right back up, trades into the settlement at 414. Again, in the upper portion right here, almost back to consequent encouragement of that CIBI on the 60-minute chart. So knowing when to trade the morning session versus knowing when to trade the PM session, when there's a very, very large gap opening, I'm not terribly excited about that. I kind of like want to sit and wait. And then if I know it's likely to draw into that opening range gap, and there's times where based on what the market does in the morning session, the first 60 minutes of trading, which I'll have a video entirely about that, it'll give me insights about whether I sit on my hands and do nothing, or I wait for a reversal and then I play after the reversal's done proving itself and kind of like tips its hand. I don't want to kind of convey the idea that you should be in here trying to capture the highs and lows and back and forth, up, down. You know, that's what the 33 years of experience Michael can do. In the beginning, you're not going to have that level of experience. So it's not reasonable or practical for me to try to inspire you to do that. If I'm teaching you and I'm telling you shouldn't try to do that initially, and then you shouldn't either, because you're acting on infancy in terms of experience. And that's not meant to be derogatory or talk down to you. It just means that we're talking practical. And if we're going to transition from demo trading and back testing and tape reading and all that to now we're dealing with real risk. And if you haven't noticed, yes, that's a AMP live account right there. And this is actually a trade that my son and I worked with, and I walked him through it, and this is what it looks like. He pushed the button clearly, but it was based on the logic that I shared with him, so that way you understand the mechanics of what's here. So again, live account, live execution, real world trade with real risk. And going back to it, you might ask yourself, what would a trade like that require in terms of a stop loss? And I don't want Caleb to have more risk than what? 15 handles on this with a micro. So what does that translate in terms of monetary risk? It's only $30. So let me ask you a question. If you were willing to risk $30, but you could make $90 or more, is that a reasonable risk to reward? 3-1. You're risking $1 to make $3. So you can be wrong a couple times in a series of trades and still be net profitable on the week, the month, or the year, if you can model that. Eventually, you want to try to do things that allow for a 5-1 or more, but you're going to need a little bit more insight and more execution and experience before you can do those types of things. So I could start with 1-1, but I know that that's going to invite a whole lot more trading ideas for some of you that are going to try to mimic and parrot what it is I'm doing in this model. And I'm not trying to inspire you to copy me. So that's why none of the trades are going to be a live stream type thing, because I don't want you to hurt yourself. I'm not infallible. I have a very large audience, and it is basically inviting, more liquidity to pool around a specific price level. And it's very simple to reprice to that and not show any real benefit of following that idea. Because if everybody's dogpiling in on the same absolute price level, if I'm live streaming, and for the people that don't know how to trade or don't know how the markets actually book price, this doesn't sound normal to them. It sounds like an excuse. But again, you're seeing broker statements, you're seeing a live account down here. These are all things that you can't fake. Okay. It's actually something that I want you to appreciate, because I don't have to do these things. Like I could just sail off into the sunset and be done. I mean, I really can. But to show you how the actual transition should be done, from back testing to logging to forward testing and demo trading, and then finally making the decision to move from those risk-free environments to now allowing and affording yourself actual risk, but then also managing that risk appropriately. So that way you're not trying to do much more than that's required. So basically, getting in with a entry point at 711.25, your stop loss would be 7126.25. So that is a 15 handle stop. So that is up here. Right there. Okay, so you can see it didn't even have any interest in getting out to that point. Okay, does that mean every trade's going to be a 15 handle stop? No, it might be smaller, but because of the nature of today, we had the election certification today. We had, all the other things that's going on. So it's just reasonable. It was practical for me to suggest to Caleb that he uses a 15 handle stop loss here, and then to target that upper quadrant of the opening range gap, and then see if he can trade lower. He could have had an exit down here. That would have been much more favorable, but we discussed it, and he agreed that let's just see if it can trade down into that consequent encouragement. If it stops him out, it doesn't matter. It's still about 50 handles or so, and that is a really good return. It's a really good return for the risk that was implemented, and if you can try to target trades where you're risking 3 to 1 or 4 to 1 or 5 to 1 or higher. You're not going to get as many trades as you could if you were trading 10 for 10. You can do that all day long when you know what you're doing. But again, this lecture series is based on the new student transitioning to live funds. How might that occur? And it's not an instruction manual for you to copy this. I'm not telling you to do this and you're going to make money. I'm showing you as an example, nothing more, just simply an example of how it could be done and how using the ideas that were taught in 24, that mentorship, I gave you a lot of wonderful, practical, algorithmic truths to what price does and why it does it. And again, another example here with a live account. It's not market replay. It's not demo. Okay. There's real money at risk here, albeit in this example, it's not much money at risk, but it's still money that, if Caleb would have lost, he would have felt it. He would have said, it's not fun. But when you have wins that are measurable based on the logic, that's sound, it repeats more than it doesn't. That means there is an edge there. And it's based on time-based delivery and price. That's not Wyckoff. That is not Gann. That is not anything else. It's simply what the market simply does because it's scripted. And by waiting for these signatures to manifest itself in price action, we can trust that the edge is now shifted, potentially, not guaranteed, in our favor. And if we follow rule-based ideas and we manage risk impeccably, we stand a good chance, not an absolute panacea, be-all, end-all profitability. It just means that we have a good chance that if we manage it appropriately, we can potentially yield a positive or profitable outcome. But because we're not risking a whole lot, we can weather the storm of a loss, a series of losing trades, and work our way out of that. And hopefully you'll see examples of that with real broker accounts and statements and things like that. So hopefully you found this one insightful. Hope it was inspiring to you. And I hope you stick with this lecture series. It's, again, 19 more lectures this month. They'll be complete by the last Friday of January and only delivered on Monday through Friday. On the weekends, there's no lectures. There's no videos. Okay. Until I'll talk to you tomorrow evening at 8 p.m. Eastern time. Be safe.